Hello everyone, welcome to PwC Tax Bite podcast series. My name is Peter, of course, and I'm welcoming you to this podcast where we'll talk about some important international tax developments. The reason is that we just closed our international tax webinar earlier today, and I've kept some of the speakers here in my virtual recording studio just to chat a little bit about what was actually discussed in the webinar. And so I have with me here Jean-Philippe van West, well known for the audience in the podcast, senior counsel in our team, and also part of his time working at the Vrije Universiteit Brussels, and he organized the webinar. So I'm happy that I could have him here to debrief a little bit on the topics. Next to that, Gilles Fransens. Gilles, well known also for the podcast audience, expert in transfer pricing, and he talked about some important transfer pricing developments in the podcast. And Joris Lutz, since the previous podcast, also known by the audience. Joris is one of our experts in the area, amongst others, of European law, tax law, and the developments. So welcome, all of you. Jean-Philippe, you are the organizer, so let me start with you. We just closed the international webinar today, but the previous one was in February. Was it already useful to have another update after a few months?
Yes, Peter, and hello to everyone. The previous webinar was beginning of February. It was a few weeks after the release of the side-by-side system. There's then you had in November 2025 the new update of the OECD commentary to the OECD Model Convention, so new guidance on mobility of work and home office PE. But since then, many developments took place, and we see the international tax landscape is moving incredibly fast with different actors. You have the OECD with its tax agenda, you have the UN with its tax agenda, you have the European Commission with its tax agenda, and then of course individual countries all having their individual tax agenda as well. Together, and of course you have tax, but as well you have the much broader geopolitical developments as well. So many developments since beginning of February, since the previous international tax webinar. So it was necessary to have a new international tax webinar, and the idea behind this international tax webinar was really we're before the start of the summer, so 1st of July. Many will be on holidays the next 2 months, or people in their tax teams or in their teams will be on holidays, to give them an update on the developments they should be aware of, so that they can go relaxed into the summer months with the feeling that they have everything under control.
Okay, yeah, indeed, a lot of developments, Jean-Philippe. What was the agenda for the webinar? Can you explain that maybe to the audience?
Yeah, indeed. Besides a general overview of the international tax landscape, we had some key developments, the key topics that we addressed. First, Pillar 2. So many those involved with Pillar 2 know that yesterday, 30th of June, was the first deadline for the Global Information Return filing. So we gave an update there for where do we stand. In some countries, facilities are ready for accepting filings. Other countries systems are not yet available, are just opened a few days ago or a day ago. So we gave an update there, but as well looked forward. What are the upcoming compliance milestones? Which other developments we can expect there? So Pillar 2, an important block. Next, of course, the tax simplification package. The European Commission just released exactly 1 week ago, last week Wednesday, their 24th of June, the tax simplification package with Tax Omnibus and DAC recast. So we addressed that one. Something that is now for about 2 years an important aspect as well on this international tax webinar update on trade and tariffs developments, and then last but not least as well transfer pricing update with their key focus on release of the public consultation by the OECD on the revision of Chapter 7, the transfer pricing guidelines on intra-group services. So that a bit an overview of the agenda and the topics we discussed.
Yeah, thanks for that overview. Yeah, and I had, of course, the pleasure to talk about the Pillar 2 developments, Jean-Philippe. You invited me there, and yeah, it was good to give a short update because, yeah, actually, we record this podcast the first day after the first official deadline for Pillar 2, and have been heavy weeks, I think, for a lot of taxpayers. Yeah, struggling to get the returns in, the filings in. So I think at this moment in time, the reality is, I think, that we see informal extensions in a number of countries or formal extensions, no penalty policies. Anyhow, it's clear that the compliance cycle will continue over the next weeks to come. So I think it's good that to reflect a bit further on the lessons learned, I think, from the compliance cycle. And I think our intention is clearly to organize a specific webinar on Pillar 2 after the summer, share a bit the lessons learned from the first compliance cycle, because let's not forget, the next one is already the second year for calendar year taxpayers is already on the 30th of March. So that will be very, very soon. Anyhow, we don't have time to go in the detail of all the topics that were on the agenda. But let's try to give a little bit of a summary in this podcast. And Joris, maybe can I start with you because some time ago we recorded a podcast on the information that was then widely shared in media on the announced Tax Omnibus package. The version we have seen then compared to what was officially published, were there a lot of differences?
Good question, Peter. And I would say the short answer is no, not really. No major changes compared to the earlier publicly leaked version. It is still the most comprehensive policy alternative that the Commission put on the tables with major changes to 6 direct tax directives. I will not go of course, through everything again in detail. I'll just highlight what stays the same and where there are any differences, if there are any differences at all. So what were the directives in scope? First, the Interest and Royalties Directive and the Parent-Subsidiary Directive. There, everything stays the same. There's still 2 central themes. First, the abolition of the participation requirement in both directives and more effective withholding tax relief procedures without administrative formalities at source, or more effective and timely refund procedures. And that last item ties in with the change that is proposed to the FASTER Directive. Also, in respect of the Tax Merger Directive, nothing new compared to the earlier version. There is still an alignment to the Corporate Law Mobility Directive and the corporate restructurings that directive provides for, and as well a new tax neutrality regime for so-called cross-border conversions of legal form. As well, in respect of the Dispute Resolution Mechanism Directive, nothing new under the sun. This is the same as what was discussed in our previous podcast. Nothing new to flag there. Where it gets interesting is the Anti-Tax Avoidance Directive, because that was where some important changes were being proposed. There is still, in comparison to the earlier version, the introduction of a beneficial rule, an EU-wide R&D allowance, so that ambition is retained in the final proposal, and still the important changes to the existing anti-avoidance rules in the Anti-Tax Avoidance Directive, a clarification of the general anti-avoidance rule, the abolition of the imported mismatches rule, a restriction of the CFC rule, and of course, important amendments to the interest limitation rule. And there is one change compared to the earlier leaked version. The leaked version had proposed to make the de minimis threshold, which is currently in the directive of 3 million euro, to lift it up to 5 million euro and to make it mandatory. Well, in the final proposal, the threshold remains 3 million euro, but of course it would be mandatory going forward. That said, I would say the other amendments to the interest limitation rule that were already in the leaked version and that are quite beneficial, those remain. So a mandatory 30% EBITDA cap, an exclusion of third-party loans that are used for the taxpayer's own activities, a mandatory group exclusion, and a mandatory carry forward of exceeding borrowing costs and unused deduction capacity. Those remain in place, as well as a few other rules, which is also more clear compared to the leaked version, which did not yet provide any timing or clear timing. The omnibus proposal that was effectively published would generally apply as from the 1st of January 2029. At that point in time, the rules would effectively kick in the member states. But some rules would only become relevant as from a later point in time, 2032 or even 2037, and that is the case for many of the beneficial amendments in relation to the Parent-Sub Directive and the Interest and Royalties Directive. So there's, I would say, clearly a phased timeline, which means that some amendments, some important amendments, may only become effectively tangible in a distant future.
Okay, thanks, Jur. It's a very concise and clear overview. Thanks for that. People want to know more. I can make some publicity. Join the webinar, I would say. Jean-Philippe, anything you want to add to this topic?
Yes, Peter. From what was interesting during the webinar that we had, we put out there was a polling question that we put there, and we asked the audience, okay, you have this 6 tax directives that Joris just summarized there, and together in the question, and we will come to that in a minute as well, you have a DAC reform, so the reform of the update of the different DACs. And we put the question, okay, if you could, as a business, if you could choose one proposed EU tax simplification measure to be adopted, and there, without taking into account how likely it is to be adopted, so not taking, well, will there be a unanimity achieved or not, so leaving that aside, which one would be the most beneficial for their business? And yet the option also removal the participation threshold under the Interest and Royalty Directive, Parent-Subsidiary Directive, second, mandatory changes to the aided interest limitation rule, such as the 3 million euro safe harbor. Thirdly, changes to the DAC and other simplification measures in the DAC, or the carve out from CFC rules for entities subject to Pillar 2, subject to certain exceptions, or any other changes. And what was interesting there, that there was all of them received votes, but the clear winner was the removal of the participation threshold under the Interest and Royalty Directive, Parent-Subsidiary Directive, followed by changes to the reporting obligations under DAC 6, which would then be streamlined. So I think that was an interesting insight to share, I believe, with the audience.
Okay, thanks, Jean-Philippe. And yeah, you already referred to it, the DAC for recast, another document that was published. Joris, can you maybe also give the highlights of that second document?
Sure, Peter. This is also a really interesting proposal to me, and yeah, as per the European Commission, this DAC recast has, in a way, a double objective. On the one hand, the Commission, wants to bring the DAC, the Directive on Administrative Cooperation, and its 8 amendments into a single coherent text, so more legal certainty. And on the other hand, it clearly wants to cut red tape, so less administrative burden and fewer reporting requirements for businesses. Let me start with Tax 6 and the proposals that are made in that respect, because a lot is moving there. First, the legal professional privilege rules. These rules that are currently in the directive are modified to align the directive with the case law of the Court of Justice. Secondly, and I think this is a big novelty, as Jean-Philippe already highlighted, there is a Pillar 2 carve-out for DAC 6 reporting. So entities subject to Pillar 2 would in principle be carved out from the scope of DAC 6, but there is an exception. This carve-out does not apply if the group is headquartered in a jurisdiction with a side-by-side regime and it has entities that implement reportable cross-border arrangements, and they involve jurisdictions without a QDMTT. So there is a carve-out for Pillar 2, but I would say with an important nuance which should be monitored. Thirdly, also in respect of DAC 6, there is a simplification, I would say, of the hallmarks. The generic type A hallmarks would be entirely removed from DAC 6. And in respect of hallmark C1, which also refers to certain non-cooperative jurisdictions. In that respect, only the EU blacklist would be relevant going forward, so no more implicit reference to the OECD work on cooperative, non-cooperative jurisdictions. On top of that, it is announced that guidance would reportedly be issued in respect of the main benefit test, which oftentimes creates lots of uncertainties. And the goal would effectively be to reduce what is called purely defensive reporting of standard commercial transactions. So if that guidance would be issued, that would be quite welcome to me as well. Also, a clarification and a beneficial extension of the reporting deadline. So the initial, what is currently provided in the directive is a reporting deadline of 30 days. That is increased to 90 days. And this reporting deadline would only start to run as per the proposal once the first step of the implementation has actually been made. So no more references to making available for implementation or being ready for implementation. And that would also, in practice, I believe, bring more legal certainty. In DAC 6, one more interesting detail, a provision is included in the proposal that would give the Council of the EU the power or the obligation to adopt a so-called implementing act with the criteria for substance, so substance requirements, and that would be tied to hallmark D2. So in a way, this seems to preserve part of the ambitions of the so-called Unshell Directive or ATAT 3, which has now been withdrawn. So some of that work would or could be now embedded within DAC 6. Of course, besides DAC 6, there is also there are also proposals in respect of other DAC directives. I will just be brief and name a few. So, for instance, under DAC 7, which is about reporting by platform operators, the activity threshold of 30 and the monetary threshold of 2,000 euros per year would be amended. So this activity threshold would be removed, and the monetary threshold would be raised from 2,000 to 3,000 euros per year. And on top of that, simplified obligations would apply to so-called intermediary sellers, aside from some other proposed amendments. Leaving DAC 7, also in respect of DAC 4, the country-by-country reporting, and DAC 9, the global information return, also some alignments there. So the notifications needed for DAC 4 and DAC 9 would be consolidated in a way. The proposal puts forward a single notification which covers both, which can be made on behalf of all EU resident group entities and which would be filed by the reporting entity. Another maybe important item to note is that the Commission is also developing a central tax identification number verification tool, a TIN tool, and the idea would be to reduce the need for additional data collection by reporting entities. I think that is, from a substantive perspective, in a gist, what is covered by the DAC recast, and what brings me to the timeline. So most of these simplification measures would apply or should be in place as from the 1st of January 2028, with remaining provisions following by the 1st of January 2030. So to wrap up, I would say, all in all, a welcome proposal, a proposal that I feel genuinely tries to reduce administrative burdens and create more legal certainty.
Thanks, Joris, again for that concise summary. Jean-Philippe, what are then the next steps for these proposals?
Yeah, indeed, as you mentioned, it are proposals by the European Commission. So these two documents, the DAC recast and the Tax Omnibus, this will now published by the European Commission, now will form the starting point for negotiations between member states there, because their unanimity is needed to adopt them. What is interesting is that today, 1st of July, the Irish presidency of the Council of the EU starts. And if you look at the agenda that they released a few weeks ago, if you look there, is the simplification, the tax simplification agenda is very high on the agenda of them. And they say the DAC recast, they want to make this a priority and want to they want to, or like at least they will try to reach an agreement under their presidency. Of course, if you want to, as Joris mentioned, if you look the proposal implementation, most of the measures in the DAC recast, 1st January 2028. If you know that if a directive is adopted, that it still needs to be transposed into domestic legislation, well, a quick agreement at EU level is needed there. So that's important. And maybe there with the DAC recast, if you look back, so we are already at DAC 9, the speed at which they were adopted was very fast, much faster than most other tax directives. So in that regard, it could be like this can have a bigger chance to be adopted quickly or that unanimity is reached rather quickly on this one. The Tax Omnibus, on the other hand, there the timeline is a bit, so there if you read the Irish, the agenda of Ireland, there they say, okay, they will want to work on the Tax Omnibus, but it's not directly their ambition to reach a final agreement under their presidency yet. So work on it, but that will probably take more time. And in particular, because some of the measures proposed in there, such as the removal of the participation threshold under the Interest Royalty Directive, Parent-Subsidiary Directive, have potentially a big budgetary impact for some member states. So there it might be harder to reach unanimity there. So in one sentence, DAC recast really will be the focus to reach agreement there soon. Tax Omnibus will work on that as well, but probably there the timeline might take more time to reach agreement there.
Okay, yeah, exciting to see what will happen in the next months with this, Jean-Philippe, and indeed, if a lot of changes will still happen to the proposal and so on. Yeah, that was not the only thing that moved around. Also at OECD level, there were some changes and some developments. And Gilles, that brings me to you, of course. Earlier this month, there was also a podcast on the OECD TP guidelines chapter on intragroup services. This was also an important topic on the webinar. Maybe good if you can just remind the audience a little bit what it was about and your experience with this.
Yeah, sure. So it's quite an important policy development for transfer pricing, I'd say. So it's a proposed revision to the OECD transfer pricing guidelines, and then specifically, as you say, Peter, a revision to the chapter in those guidelines which deals with services. And that's quite an important transaction type with quite a bit of transfer pricing controversy around it already today. The reason the OECD issued this discussion draft is actually due to the fact that the last version, so the current version of the services chapter, actually dates back to 96, so 1996. And the goal here is to bring this chapter more in line with the rest of the OECD guidelines, which was updated much more recently, most of it during the BEPS project with final guidance in 2015. The current draft, though, does go further in a few domains. So it does add some additional elements into that discussion draft. And during the previous podcast, we went into quite some detail into what those main changes were. So I won't do that again here. What I thought was quite interesting and I thought worth sharing in this podcast is that in the webinar we had earlier, we also introduced a few polling questions to get some takeaways from the audience in terms of how service transactions are structured within their organization. And there's three takeaways that or three sort of takeaways from the polling question that I wanted to share. So a first one is that the sort of cost plus typical service transactions, so where services are remunerated based on the costs incurred by the service provider with a markup on those costs, that is still by far the most popular way in which services are being priced. Also for situations where there's sort of senior management involved in providing the services, or where, for example, local IP is deployed in rendering the service. And that's an area which already today is subject to quite some controversy, but with the new guidance, there's quite a few examples in there and some additional guidance that's bringing the entire discussion a bit closer to a profit split under certain facts and moving away from the more standard approach which we see in most groups being the cost plus. The second piece is then on documentation. So that's also a very important change which was introduced in the discussion draft. So much more emphasis, focus on having that documentation in a contemporaneous manner, but also the extent of documentation being much broader compared to what, well, our experience is typically, and that's also what you saw in the audience during the webinar, that the documentation levels today are still relatively limited for a lot of groups, with most of it done during controversy discussions. So that's also another area where the current version of the discussion draft, if that makes its way into the final guidance, can significantly increase the documentation threshold for a lot of groups. So that was the second one. And then the last one, which I thought was maybe even the most interesting one for me at least, is actually not a tax-related observation, but we basically asked the audience, well, what is the main challenge that you're currently seeing when it comes to service type transactions? And then we listed a bunch of considerations like really tax related, like type of challenges groups could be confronted with. But what's very interesting is that the most picked answer here, so the challenge most groups are dealing with, is actually internal management discussions, KPI discussions, where certain entities are actually debating whether the service rendered is actually providing value, yes or no. More so from a KPI, internal KPI reporting perspective, rather than from a tax or controversy point of view. And that's also something that we've started observing a lot more in practice, sort of the importance of transfer pricing to manage internal management disputes, if you will. And you see that coming across in the audience poll here as well, that is really ramping up. So I think that's quite an important one, and maybe an unexpected area where this guidance will be of quite some importance is on how to deal with internal management discussions when it comes to intragroup services. So with that, Peter, I'll pass it back to you. Those were some of the main thoughts that I thought were still worth sharing.
Yeah, thanks, Gilles, for sharing that. It's very, very interesting. We're moving towards the end of the podcast. We covered the topics that were discussed in the webinar. So maybe a final question I maybe have, Jean-Philippe, for you. Back to you. Maybe if you can dust off a little bit your crystal ball. What do you expect to see happening in the next months? What's your prediction? Will the pace slow down a little bit? What can people expect according to you?
According to me, it will remain very busy during the summer. So although that some of us might take holidays, international tax policy will not take holidays. So on the one hand, and if I can select 4 topics I would like to address on the first topic is, of course, Pillar 2. Pillar 2 compliance will continue, although the deadline was 30th of June. The next, not all countries, they were not ready yet for filing compliance. So this will continue the weeks to come. But as well, the OECD announced an update on the revenue estimates. So webinar taking place there. What is the money Pillar 2 will, additional tax revenue Pillar 2 will bring in there. Potentially as well new administrative guidance that we're still already waiting for quite some time now. So lots certain developments with respect to Pillar 2. Second, of course, the EU Tax Omnibus tax reform, the documents have been released now, but the months to come, countries will start discussing these, so we will get insights there on, or like have a feeling, where do we stand, what is the position of different countries there. Third, the UN. So as well at UN level, there will be the next, so on the UN Framework Convention on International Tax Cooperation. There in August, the 5th session, Intergovernmental Negotiation Committee will come back together, taking place the 3rd till 13th of August. Will come together in New York. And there, as you remember, there the timeline that within this UN Framework Convention, they want to reach or conclude these negotiations by the end of 2027. Well, if you're in August 2026, that's then you still have about a year. So expect their negotiations to intensify. There that we will see more documents there. So it's well something to keep on the agenda. And there, what Gilles said is. With this public consultation on update of Chapter 7 intragroup services of the transfer pricing guidelines, there the deadline for public consultation is 22nd of July. So there as well, when this information is reaches the input reaches the OECD, there they will probably have as well an event there to discuss these. So as well there, these developments keep on going. So definitely enough food for a new international tax webinar somewhere in September, I would say.
Okay, thanks, Jean-Philippe, for sharing that. Very interesting to have your perspective on things, and I'm sure the audience will agree. This brings us to the end of the webinar. So thank you, Joris, Jean-Philippe, Gilles, for sharing what you discussed in the webinar and your thoughts on it. Thank you for the audience to tune in again for my podcast. So appreciate that. And I'm sure we'll be back with more updates in the coming episodes. Thank you.